Good evening. Welcome to the class. So our topic is Chapter 8, Equity Portfolio Construction. How are you guys all doing? Good?
Good.
Tired? Yeah, not yet. Okay. So that's good. So let's talk about passive versus active management. Do you guys remember the difference between passive and active? What is passive?
You just buy and hold.
Buy and hold. Okay.
And the aim of the portfolio manager is not to beat the market.
Yes. Exactly. So an example of passive investment is investing in index fund, right? And what is an index fund? It follows the index, right?
Yeah.
For example, Vanguard has an S&P 500 index fund, right? Which has a ticker of this one, right? Okay. So the passive equity management was born in 1973 when Wells Fargo Bank introduced it to the institutional investors, right? Like Vanguard and others. In 1976, Vanguard began to offer an S&P 500 index mutual fund to individual investors, which became the single largest mutual fund by 1997. And you can get some idea about how large that fund is by looking at this data I pulled up. As of August 31st, 2025, the total net asset value of funds indexed to S&P 500 and managed by Vanguard stands at $1.3 trillion. And there are so many other companies which have index funds tracking S&P 500 index, right? So if you go to this link, you can also look at some other. So, right? So it is huge. BlackRock has, Schwab has their own index funds following the same index. And they will have different share prices. Can you tell me why? For example,
Could be for like transaction costs and stuff.
transaction cost should affect them similarly. The main reason is how they divide the entire assets under management in how many shares. If you have a large number of shares, share price will be lower, right? If you have a smaller number of shares, share price will be higher, right? Given the same assets under management, right? So that's why index has a different price and different index funds have different prices, right? How it is constructed. But it doesn't matter for you as an investor, your return will be the same. Very similar. if an investor invests in Vanguard, and if an investor invests with BlackRock or Schwab, their returns will be very similar. The difference is, again, is captured through expense ratio. I might have talked about the expense ratio. Expense ratio includes different kinds of costs. For example, management fees and others, right? Transaction costs and others. So Vanguard tends to be the low-cost provider, right? But S&P 500 index fund is so popular, so much widely available that in terms of expense ratio also, there is not a lot of difference between Vanguard and other companies. So that was about passive. And active management is, so as Rick was saying, passive is buy and hold, right? You don't manage it day to day based on your expectations, how the market will perform, or how particular stock will perform, or how particular sector will perform. Can you give me examples of some sectors? When I say sector, what do I mean?
Industry.
Industries, exactly, very good. Can you tell the names of those industries?
Tech.
Tech, very good.
Hospitality. Service.
Good. So yes, those are, you are right, but there are some what is the word? Some designated names. For example, consumer staples is one, right? Consumer staples are that sector that includes companies that manufacture or deliver essential items, right? Like in the grocery business. Discretionary is like something you don't need, but if you have money, then you will probably spend, like buying a new car. Technology obviously is one of them. Financial services, utility, energy, right? Those are different sectors. These are the sectors I was actually naming, right? So some people say consumer cyclical instead of consumer discretionary because it responds to business cycles to a large extent. For example, when there is a recession, people will feel constrained financially, right? They will hold off buying expensive things, right? So that sector, consumer cyclical, will be affected significantly, right?
So are they arranged based on their, I don't know, how can I say, based on how large they are? I see technology, it's the first one.
So these are names of different sectors. Now, which company is included in which sector depends on their type of business, right? Walmart, Target, they will probably fall in consumer defensive. Again, consumer staples. It has another name, consumer defensive. Healthcare, United Health and others, CVS. Industrials, probably GE. GE has so many different kinds of business. Caterpillar, right?
So what I'm asking, are they arranged based on their share in the market?
They're arranged, you mean, in this here? Yeah. So it is based on their exposure in that fund, in that index. So
Okay, technology as the, okay.
right, for example, let's say $100 million goes into this index fund, right? So because high tech is overvalued or it has a huge exposure, that's why you see 34.79%, meaning within $100 million, $34.79 million is invested in technology companies like Microsoft and NVIDIA. Yes. So now when we talk about active management, portfolio managers have different investment philosophies. I mentioned one of the very prominent ones is value versus growth. Some portfolio managers follow value investing style, others follow growth investing style. Portfolio managers who say they follow value investment style, they try to find out undervalued companies in the market. And growth portfolio managers, they try to find out companies they expect will grow at a higher rate than the average market or their industry, right? And the objective is these portfolio managers think they can beat the market or their benchmark or their peers, right? Depending on who you compare with. However, if we look into the historical record, the evidence is mixed. For example, the active large cap managers have underperformed the Russell large cap indexes. So Russell large cap index is what? The largest 1,000 companies, and it is an index. So if you follow the Russell large cap index, then it will be a passive investment because everyone knows all the companies that goes into Russell 1000 index, right? So think about it. If you just follow this passive investment approach and do not pay extra to your actively managed portfolio, then you outperform the portfolio managers who saying they can identify those large cap companies, they will outperform the market or outperform their index, right? But again, remember, index is a theoretical construct, right? Theoretical construct. So it doesn't have any transaction cost, right? So that's why this part of the sentence is very important. It says the active large cap managers have underperformed the Russell large cap index due in part to fund expenses. So for example, let's say as an example, there is an actively managed portfolio and it has performance of 10% annually, and the Russell large cap index has 12%. That 2% difference they're saying is actually because that fund, it deals with actual money, it has transaction costs. That's why. Just to give you an intuition. So it is very, very difficult to beat the market, at least in the large cap sector. But if you look into the performance of active small cap managers have outperformed their indices, right? Having all that said, though, the period analyzed affect the conclusions. So, for example, maybe this result is over a long period of time. Remember, we saw some statistics over 25 years, 5 years, right? 15 years or 10 years, I forgot we saw. So the results differ, right? Obviously, you can think of the reason if you were let's say you are much older, and in 2008, 2009, you saw the market crashed, but you know the market will pick up. So if you invested during that time and just didn't do anything, your portfolio would have significantly outperformed the market now. Isn't that right? So it depends on when you calculate for how long, what is the starting point of your measurement, right? But still, there are investors and there are portfolio managers who believe they can create additional value through actively managed portfolios. For example, if you look into this chart, right? In 1970, even in 1985, there are only 519 equity funds. In 2000, it went to 3,315. In terms of assets under management, from 103.4 billion in 1985, US equity funds now manage $3.4 trillion, right? In 2000. And if you look into 2016, assets under managed grew even more, right? So there is still a huge market for active management, although there is no clear evidence that actively managed portfolios outperform the market. So first of all, you have to keep in mind, there are very successful, smart, actively managed portfolios. But probably they are not publicly available, this data, right? So those successful active managers are not always known to the public. That's one. On the other side, if a portfolio manager, active portfolio manager does not perform well and goes out of business, they actually are not reflected in the statistics. As a result of that, the data that we see are actually existing fund managers. So our statistics is also biased upwards, right? All this just to tell you that, yes, it is possible to beat the market, but it is very difficult to identify those portfolio managers. Now, so we talked about index fund, and there is also ETF. What is the major difference between index fund and ETF? Or mutual fund and ETF?
Isn't index funds just with stocks?
So index fund could be on bond.
How could we bond too?
ETF also can be also on bonds. The main difference is mutual fund you cannot buy on an exchange. ETF you can. So you can think of it, these are just two different vehicles for the same purpose. So if you want to invest in the S&P 500 mutual fund, you have to directly trade with, let's say, Vanguard. But if you want to buy their ETF version of the same thing, you can buy even on Robinhood, right? So it's very easy, right, to trade in ETF. Small investors like us can also trade in ETF. Small investors like you who do not have a full-paying job yet, right? You can also buy ETF. Mutual funds tend to have some minimum investment. ETFs, if you have just $1, you can invest in ETF. Okay. For example, remember I mentioned this VFIAX. So that is a mutual fund. Let's say it has $3,000 minimum investment required. If you cannot invest $3,000, what you can do, but if you want exposure to the same index, S&P 500, you can invest in BOO. They're the same thing in terms of exposure, right? So this is what it is saying. Lower fees have possibly led to the success of index mutual funds. The additional benefits of ease of trading has led to the growing popularity of ETFs. So we talked about the basics of active and passive management. Now, how do we construct a passive portfolio? So if a portfolio manager is indexing his portfolio or is managing a portfolio indexed to the S&P 500, he will try to manage his portfolio in a way the returns of his portfolio exactly match the returns of the index, right? And the difference we call tracking error or tracking risk, right? So successful S&P 500 indexers, portfolio managers track within a few basis points before management fees. Whereas Russell 2000 small cap index perform within tens of basis points. Why? Because this is a small cap index. These are smaller companies, lower turnover, higher transaction, less liquidity. Institutional investors select index funds based on the record of tracking error and the level of management fees. So if you are an index fund manager, very, very important for you to construct the portfolio in a way that mimics the performance of the index, right? Everyone understands this? Okay. Now, how do you do that? One obvious way, of course, is full replication, right? S&P 500, you want to create an index fund following S&P 500, you just buy or invest your money, you being the portfolio manager, in the same way that the index invests. S&P 500 is market value weighted. For example, I showed you, and Edward was asking question about sector. Technology had the highest weight, right? So similarly, each stock has weight in the S&P 500 index. Under full application, you will buy each stock in the index in exactly the same weight, right? There will be still a difference between the returns of or performance of your fund, the portfolio manager's fund, and the index. Why? Because of the so there will be still difference if you replicate the index. If you buy the same securities, same number of securities in their exact weight in the index, still there will be difference between performance of your portfolio and the index. Why? I mentioned in the beginning. Fees, exactly. Expense ratio, right? And one of them is transaction cost. Index doesn't involve any trading. It is just a theoretical measure. Isn't that right? No buying, selling in terms of index. It is just a theoretical measure. But when you actually construct a portfolio, you have to buy, sell. Even in S&P 500, new companies are added. Some companies are removed because the 500 largest US companies change, right? So again, full replication is the obvious way to mimic the performance and to reduce the tracking error between the index and an index fund, right? Managers try to reduce trading costs and keep cash to a minimum amount to minimize tracking error. But sometimes, so some indices are large. It's a relative idea. 500, you can also consider 500 is large if you are a retail investor, individual investor. But think about Russell 1000, Russell 3000. these are obviously larger. So if you want to replicate, if you want to follow full replication, then it will involve a lot of trading. It will involve a lot of transaction costs. So in that case, you can follow sampling. Of course, it will not be the same as the index, but you can follow a specific sampling process and then methodologies to minimize the difference between your index and your portfolio, even though that portfolio is not a replica of the index, like in full replication. We are going to talk about that actually in this class. We are going to construct an index portfolio, passive one, and an actively managed portfolio. So under sampling, so you have to sample from an index, large index. How do you sample? Let's talk about few characteristics that actually matter in terms of portfolio's performance. Homa and French, right? They showed to the research that size, meaning large, medium, small, let's say, and style, growth versus value, are two major factors that influence security returns. So what that basically means then, when we sample from the index, we need to make sure we have enough representation of both size, different size groups, large, medium, small, and different style groups like value and growth, right? Because their characteristics are different. They use market capitalization. What is market capitalization? What information do you need to calculate market cap of a company?
Shares. And outstanding.
Sorry?
Shares.
Outstanding and?
Price.
Exactly. So market cap is just another name for common stock, right? So we can use market cap as a measure of size and book to price. Sometimes you will see this written as price to book. So it's a matter of choice or preference. As a simple measure of style exposure. So let's say and what is B on the numerator? What does B mean? B or book value per share. Okay. And P, price per share. Now let's say you have two stocks, A, B. One has 3, another has 7. Based on this, which one will be a value stock, which one will be a growth stock? Just based on this, let's say. More likely to be value stock, more likely to be growth stock. What is the definition of a value stock? Undervalued. A will be value stock. Does everyone agree? So you want stock which are underpriced. So this should be lower so that the ratio is higher. Isn't that right? So which one will be value stock? B, right? Okay. Did I say A, yes? So my mistake. So this will be a value stock. And this will be a growth stock. So this will be opposite if you use P over B instead of B over P. Right? Any questions? No? Okay. So there is another scholar here, Bar Rosenberg. He identified additional style factors and also industry affiliations. So what that basically means, all those sectors that I mentioned, consumer staples, discretionary, healthcare, they also have specific characteristics which have particular relationships with their returns. One stock, just because one stock is in, let's say, healthcare industry and another is in technology industry, that should matter in terms of return. Okay. So this is another factor we need to consider then in addition to size. What did we see in the previous classes? Larger cap or smaller cap companies have higher returns over a long period of time. Was it larger cap or smaller caps? Smaller cap, exactly. And more specifically, value. Small cap value, right? Okay. So like size matters. And also, like I mentioned, value also matters, right? Similarly, industry affiliations also matter. So we need to account for those things. So we can, if we are able to identify all important factors, like size is one factor, style is another factor. So there are many other factors. And let's say this F represents each factor. And let's say we can identify that there is actually K number of factors that affect return. Then we can come up with this model. So here, again, the number of factors is K, starting from 1 to K. Aij, I means each security, J is sector, Fj. This is the return on the jth risk factor. And Aij is security I sensitivity or exposure to this factor. Sensitivity or exposure to this factor. You look a little confused. So what I have done, maybe I can compare this with our CAPM model. Everyone knows what is CAPM, right? Capital Asset Pricing Model. So if you look into, this is a much simpler model. In this model, we are saying there is only one factor that matters in predicting expected return, which is the market factor. Expected return from the market minus the risk-free rate. So this is our market factor return, just one factor. And in the previous model I showed you, it has multiple factors. K number of factors, K could be 10, K could be 5, depending on which equity risk model we use. CAPM has a factor K is equal to 1. This one is the exposure of sensitivity. Why? Because what does this beta measure? If beta is higher, return will be higher. Beta is lower, return will be lower, meaning expected return, right? And this additional E, because no model is perfect, actual return will always be different from expected return. So that difference is what we call security specific return. Now imagine an equity risk model, not for only one factor, there are K factors. So that's why this risk model looks little complicated, right? But that is the idea. And just to relate to it further, most of you have taken the quantitative investment analysis class with me, right? And remember there was Fama-French 4-factor model. There was momentum, one of the factor. Small minus big SMB was another factor. That's okay. So that was another type of model. So what happened? So when CAPM was invented, probably in 1950s, right? So many years ago, it was a very powerful model. But the market became more efficient. Then in I forgot when Pharma French came up with their 3-factor model. And then there was another person, Carhart. He added one more factor. So it became 4-factor model of Pharma French and Carhart. So similarly, there are more extension to the equity risk model, and because we can identify more factors as we know more about the market. Okay. So to save time, and there are commercial vendors, for example, Barra and Northfield, they also provide risk models, equity risk models. Yes, we can use risk model in our portfolio to construct an optimal portfolio, whether passive or active. But the disadvantage is it can be very complicated. For the purpose of instruction, what we can do, we can use solver in Excel, even without a risk model. But we have to make some assumptions. The assumption we are making is we will account for different styles, value versus growth, different size, large, medium, small, right? And what is the ratio that we use to identify style? Is it PE, PB? Whether a stock is value. So when I say style, we mean value versus growth. So how can we, which ratio can help us to identify whether a stock is more likely to fall into value category or growth category? PB, it is on the board also. Okay, right? So we are going to include PB in our model. Although it is not a formal equity risk model, but it is an optimization model, right? So that way we can account for our exposure to different sizes of company, because size matters in terms of what will be the return, right? Over a longer period of time, small cap stocks have outperformed the large cap stocks. That one. Another is we will also use market cap, right, for what I just mentioned. Small cap stocks outperform large cap stocks. And then remember, the sector also matters. For that, we'll also account for different sectors. We'll make sure that we have in our sample companies from different sectors. Okay. Is everyone good so far? And we are doing this because we don't have access to a very sophisticated equity risk model. That's one. We can buy their models. Barra, that is a company. Northfield, I mentioned. But at the same time, those models very sophisticated, but they also have their own limitations. Okay. So what we are going to do, we are going to use an optimization model in Excel. So let's do this. I'll talk more about this if we have time. Go to your D12 and so it says Yeah, download this portfolio construction Excel spreadsheet.
Portfolio construction student.
Hmm?
See portfolio construction student.
Portfolio construction student, yes. So what we are going to do, we will construct two types of portfolios using securities from the S&P 400 index, which is a mid-cap index. Tracks the performance of mid-sized US companies. And what are those two portfolios? One is optimal index portfolio, which is an example of passive investment. Another is optimal active portfolio, which is an example of active investment. Our first activity will be, first we will create a sample. Construct a sample of 100 securities. 400 actually is not a large, but to help you see how the construction process looks like. We will assume 400 is large. We want to have a smaller sample of 100 securities that will mimic the performance of the S&P 400 index. Okay. We'll create a sample of 100 securities accounting for size. Remember, again, I mentioned that different size companies have different rates of return. Smaller cap companies tend to be riskier, so that's why they also generate higher return. Style, and we are going to use PB as a measure for value or growth. And then sector exposures. We'll account for this. Also, we'll meet one of these two constraints. So, and I'll explain this more. Let us start our construction process. So we want to mimic the performance of the index, right? So we want to have market cap similar to our index. So we need to know then what is the average market cap of our index, right? So what we are going to do is, first of all, these are the weights, right? So this is actual data as of December 30, 2016. So if you sum all these weight, you should have 100%, right? Okay. So this 0.62% mean, if you just follow full replication with $100 million, you'll invest 0.662 million, right? Which is 620,000, right? You'll use that much money to buy ID access, right? Similarly, all the weights. So some product of our weights I'm going to lock this, comma, market cap. So weighted market cap. So it is a better measure of the market cap on average than just calculating an average. So, for example, your GPA is weighted average. Isn't that right? Sorry, say it again. Edward.
We just lock the weights, right?
We locked just the weights, yes. And this is how much you should get. Let me show 2 decimal point. And just for clarification purposes, how are these weights calculated?
Market cap divided by the total one.
Exactly. So this market cap divided by the sum of all, right? Actually, the formula is here, right? Okay, so now what we are going to do, I will pull down only up to this. Now there is a problem here, right? Me, you cannot see?
Thank you.
So what is the problem? It did not shift correctly, right? It did not move correctly. Why? Because we are working in columns, but ours are in rows, right? So we can manually fix it. We can move this. Right? And instead of market cap, what do we need? PB, right? PB. So you can actually grab from the border, from on any border. So, yeah, so for example, bring your cursor here, now push on the left and drag to the right. There you go. But one up. Make sure these numbers match. These didn't match, so that means. So you have one more extra, right? 2 extra. So actually, what you have to do. Okay. Now hit enter and make sure you have the same numbers as I do. Now we want to know what is the exposure in each of these 3 different sectors, right? To keep things simple, we are only included 3 sectors. One is cyclical, another is financial, another non-cyclical. Cyclical means the business of these companies falling into this sector respond strongly to the different business cycles. If there is a recession, they may have poor business. If there is high growth, they will have higher business. Non-cyclical means, so for example, it will be consumer discretionary, automobiles and others. Non-cyclical is opposite. Not exactly opposite, meaning it doesn't respond as much. Regardless, we are in recession or high growth, we still will need, let's say, toothpaste, cereal, right? We may buy maybe cheaper options, right? But we will still need those products and other essential services. And financial is self-explanatory, banks and others. So in this case, what we are going to do, Now we are going to use INT, this formula. And then I'm going to select this broad sector column, lock them, close, equal to my first, we cannot see it from here, but it is the first sector, cyclical. I chose the cyclical cell here. And then close.
Close equal to C5.
Equal to C5, yes.
Excuse me.
So you have to do a project very similar to this. Your homework is part of this on a different index. Part of what we are doing, your homework. So what we are essentially saying, add the weights for only the sector which is in C5, right? So because C5 is cyclical, it will add the weights only if there is a cyclical. So this one, so on and so forth. Okay. What is the problem?
You have to put if or int.
Should be some
Some product. Okay, lock.
Always bracket something.
Sorry, say it again.
What is int? EINT?
INT, yeah.
Needs to be.
So now int is correct.
Oh.
Let me see some product B10. C5. Let me see what is in C5. That's correct, cyclical. Oh, I see. So you see this parenthesis, this one, you don't need this.
Yeah.
What, right? So now just pull down. It will work because we have locked everything. And if you add all these waves, it should be 100%, right?
That's right.
So we found out some statistics about our index. The average company has a market cap of, these are in millions in 2016. So 5.15 billion. Average PB of 5.36. 55.57% in the cyclical, 32 in financial, 12 in non-cyclical companies. Okay, we did that. And then we are going to go to sample template. What we need in the sample template, we'll go back to data template and copy from A10 to the end, 409. So Control C, come here and paste values in B6. So right click, this is paste values. Actually, we don't need the last column, so I'll go back again, copy only up to broad sector. Control C. Come here in B6, paste value, only up to broad sector. And then what we are going to do, it says sort by index weight, so that the larger cap stocks are at the top. So what we are going to do, highlight this range only from B6 to F405. Go to data, sort. So highlight this range without the column heading. Go to sort. Because we did not select column heading, we are going to unmark this. My data has headers.
Go over one.
Yeah, so from here you mean?
Copy, okay.
Yeah, so you copy pasted here, right?
Yes.
As values. Okay, now highlight this entire block. So do not include the column heading. Then go to sort. Unmark my data has headers. So sort, sort, S-O-R-T, sort. It should be in data menu.
Okay.
And then unmark this and sort by our index, so which is column C,
C.
largest to smallest.
Large to small.
Largest. Is the smallest to largest?
Largest to smallest.
Column C says smallest to largest for me.
Okay,
Column C says for me smallest to largest. Column C.
so you can choose. From here, you can choose which one. Choose largest to smallest. Yeah. Okay, so it was actually sorted already. That's why probably you didn't see any changes. Now, again, copy them, this block, Control C. And come here, right click, paste values. So we just copy pasted
Column, right?
Hmm?
As values.
as values. Yes. So what we are going to do now, we are going to create this or divide this into 4 subgroups. So we have size, right? From 1, 2, 3 goes on 400, right? These are high to low. High to low. So that is about our size exposure, large, medium, small. We also want style, which is value versus growth, and we use PV for that. So we are going to sort by PV, that's why. But we will do it in 2 steps. First of all, so you have, let's say, 200. And within this 200, what we are going to do, we'll sort PV by PV large to small. And then the remaining 200 PV small to large. So now what we have here is we have and you can also think, so there are 200, right? So in the middle, 100. This one are large growth. And that one is large value. Similarly, you have somewhere here 300. This one is small value. Next is small growth. Do you guys follow me? So we have 400 stocks and they're sorted in weight. And because it is a market cap weighted index, so larger companies have larger weight. In other words, if you see a stock has larger weight in the index, it is the largest company, right? In the market. So within the index. And then in the next step, to account for style, we will sort twice. First on the first 200 stocks, next on the next 200 stocks. So first 200 stocks, what is happening? Of course, the end, all 400 is large to small company, right? So we are imagining this first 200 is the larger, this 200 is the smaller within the 400, relatively speaking. Now, within the first 200, when we sort by PB from largest to smallest, what is happening? Larger PB means what? Price is higher. So that means it is growth, right? So that's why I say large company and also growth characteristics. And then large, but value characteristics within the large group. Similarly, here, these 200 are the smaller companies within the 400. Here we are going to sort from smallest to largest. So small PB means what? Price is small. Isn't that right? The price is small, meaning it's a value company, right? So that's why the first half will be small value and then a small growth. You guys follow the logic? This is just to show you how to subdivide into different groups, right? Okay, so what we are going to do now then, select only the first 200 stocks. And you will see here, it is numbered. This first 100 is that first group. It will track the first group. Second 100 will track the second group. Third 100 will track the third group. And the last 100 will track the last group, the fourth group, right? So what we are going to do, we are going to select up to 200. Actually, here. So you can see
Just the Tika.
for now, yeah. So you can see the number from here, how many stocks. Remember, these are column numbers, which is not the same as stock number. So this is only just first 100, so we need to go one more 100. up to here, right? And then we can just use right arrow to select this entire block. So the first 200 stocks, that's all I did.
So the first 200 stocks stop at CHFC. Okay.
It stops at, let's see. Here, yeah, CHFC.
Oh,
Yeah.
I thought it just the.
And then sort. Make sure this one is turned off. We are going to sort by which column?
L,
L, very good. And smallest to largest or largest to smallest?
large to small.
Very good. Okay, so sort column L, largest to smallest.
Column what? Column L,
L,
largest to smallest.
And then the next 200 will be the smallest to largest. Make sure this one is unmarked. L, smallest to largest.
Okay. Sure.
Okay. Does everyone have this?
did you select first 200 or first 100?
First 200.
200, yeah.
Yeah.
Oh, yeah, right.
So if you, did not follow the, start from here, copy this
No, I
one.
did, but I had it wrong, but I was right.
Okay. So if you have to redo, start from step, first copy paste the original one. Copy paste from here. Sorry, yeah,
First 100 from largest to
largest to
smallest,
smallest,
and second one, second half is from smallest to largest.
very good, yes. So, you can also. So this one should be starting with LI. And you can check, let us check everyone, do you have this 100 security, the first 100 TER?
ER. Let's see.
Okay. Java?
Yes.
Rick,
Yeah.
So TER,
TER, okay, yeah,
you can say, how much is it?
say it again,
TER, how much?
yeah, TER, yeah,
How much is the value?
what is the value?
For L column? 2007, no, 2.767.
Yeah. Yeah. So now. Next. 100 is NBR. Okay. Now next 100 is WPG. Okay, and finally,
No, I don't have that one.
you have problem there? No?
Yeah,
Okay, you're good?
no. The third one, I don't have.
I don't, so remember the last sort you did, last 200, it's smallest to largest. Check you did smallest to largest.
For PV, I did large to small.
The first half is large to small.
The first 200?
Yeah, but
Okay.
the second 200 is smaller to large.
Okay.
So the other set of 200 starts with G and W. Are we there?
Which one?
The other set of 200.
So do you have, the last one, what do you have? Do you have this MANH?
Let's see. MANH?
Yeah.
Yeah, okay.
Okay, and what about this one? Row 304, do you have this? 99 BDC,
Yeah, that's the third set. Is that the third set? Is
sorry, what's that?
that the third set or what?
Third. The last.
B. B. Okay, yeah,
You have the same one?
yeah.
Okay, perfect. So now what we are going to do, we are going to use some random number formula, right? Excel has this function called RAND. It generates random number between 0 and 1. Okay. Hit enter.
Just move like that, oh.
Yeah, just like that. Your number will be different from what you see on my screen, because it is random.
Yeah,
Okay, so you open and close.
So, and then pull down without formatting. Without formatting. Again, do not try to match my numbers with yours in this column. So, originally what we would do, we will copy them and paste as values so that those numbers change anymore in that column originally. But I want to make sure we are following the right process. I'll give you the same, I already gave you the same random numbers. You guys follow me? Because otherwise everything will be different, right?
yeah.
Okay. Now, what we are going to do, let's look at what it asked us to do. So we have to account for size, style, and sector. And the selected securities weight in the index should exceed the 90th percentile weight. Okay, what that basically means, in this weight column, right? I will calculate percentile of our index weight, comma, 90%. So 90% of the ratio, 90% of the companies have a weight less than this. Only 10% have higher than this. So we are making sure the larger cap companies are included. 90th percentile. Now, to make sure again that you get the exact same result, almost exact, probably some points difference you'll see in the end. We are going to use a fixed value, which will be 0.004. 0.004. I showed you the process, but I just overwrote 0.004. This is what it is telling you here. The selected securities weight in the index should exceed the 90th percentile weight in the index. Use 0.40%. Enter the weight cell to match your sample with the solution. So I just typed 0.004.
To the weight.
Yeah. But everyone understand where it came from, right? The 90th percentile value.
Oh. So why I have different number from you.
You still have the formula?
Yeah.
So no. I typed the formula just to show you where our numbers came from. I want to make sure we all get the same numbers. So what we are going to do, use 0.004, just manually type.
Okay.
Okay.
Yeah. And why 0.004? It is about the 90th percentile weight. The other condition is the selected security should have a minimum value for saved random number. Okay, so let me show you this first. So, and remember, we want to create a sample of only 100 securities, right? Okay, now what we are going to do in this column, we are going to type if, open parenthesis, if this stock has a weight greater than equal to this. Actually, the constraint is which meet one of the following constraints. One of the following that do not have to meet both. So what we are going to do, I'm going to type or here, or. Yeah. Or means one of the conditions within this parenthesis. Okay,
In front of the C6, right?
right. And the log Q2. So this is our one condition, right? Another condition is, comma, this saved random number greater than equal to this random number value, a threshold we are going to use. And lock. And close. So these are the two conditions. Only one of them needs to be met. That's why or. If one of them is met, then the if formula is activated. Enter 1, otherwise 0. Close.
Q3. Q3, close. 1.
Yes. And then comma 0. Everyone follow the logic? Okay, you're good?
Yeah.
Okay. And then what we are going to do, we are going to pull down without formatting, so that our structure doesn't get messed up. Yes,
It's so invalid to me.
Yeah, mine is giving me.
invalid.
Yeah.
Enter a parenthesis after Q3,
Okay.
and then delete. There you go. Should work.
Okay, there you go.
Yeah, no problem. You're good?
This one's.
Yeah, and then pull down without formatting. Rick, you're good?
Yeah, it just gives me border.
Oh, border, yeah, then you have to select without formatting. At the corner, it should give you an option. So let's do, yeah, try to do it. You can double click on it also. So for example, can you undo it?
Oh, yeah.
Yeah, but let's undo it. I'll show you one.
Okay.
Undo one. Yeah, now you see at the bottom right corner, just double click. There you go. Now.
Okay.
uh,
Oh, wait.
It's at the
That
top,
one.
yeah,
Ah, I see.
without formatting. There you go. So you could double click and populate because
Mm-hmm.
the next column is not empty. It will not always work. Sometimes you have to, if that next column is empty or there is a break in the column, you have to manually
Okay.
pull down. Otherwise, you can double click on the bottom right.
Oh, it's only one? Everything is one?
Yeah, for now, because we don't have any value here. I'm going to show you. Yeah.
Okay.
So this is all one now, right? So because we don't have a value here, right? Now what we are going to do originally, and this is what you have to do in your homework, right? You have to go to data. One more step here. In this total cell, I'm going to sum this column.
One column.
Yes, the one column. So you probably have 400, right? Because everything is selected now. Now, this formula says, this formula says either this one has to be greater than 0.004, or this value has to be greater than this one. Now, what is this one? We can try with different numbers, right? For example, and what should be the value of this? So if we have a 1 in this column, it means that stock is selected for our sample. So what value do we need in this cell?
Higher than.
Our sample size, isn't that right? Which is
100.
100. Exactly, right? So we need to try with different numbers in this cell, so until it is 100. Try different numbers. See how much you get. So yeah, type some random numbers here, and then I will give you the correct number. I just want you to understand the logic. Let's say 0.1. No, that's not enough. 0.01. No, right? So but there is a more efficient way, of course, right? We are going to use the goal seek function in Excel. This is just to show you that yes, your Excel is responding to as you are making changes, right? So what we are going to do, we are going to go to data. What if? And goal seek. Okay, now it says set cell. So we want this cell, this where you see 395 in my screen. It can be different in yours. This needs to be how much?
100.
Type 100. And what do you want to change?
V3.
There you go, Q3. And then just press OK.
Q3.
Did it work?
Should type Q3 in there.
No, you should not type. It should select. For example, let me show you again. So let's say this is what you have, right? For now, let's say. Then you go to what if? Goal. What is my goal? This cell needs to be 100, and goal seek can change the value in this cell. You just selected this cell. You can manually type actually this, what you see here. And then push OK.
Where did you get the goal seek?
So you go to data. You go to data and then what if? And then goal seek.
Mine is different from yours.
Yeah, mine is.
Yes, it will be different. That's why I will give you an exact number now.
8335. That what you got? 8335?
But do you have 100?
Yeah.
Yeah, so that's good. There are multiple possible solutions, right? But we want to make sure our portfolios look exactly the same way. So that's why I'm going to give you exact number to type here, which is type 0.844.
Can you click on Q6?
Yeah. Q6. Q6 meaning this one.
But it changed the total to 95.
If you type 0.844.
So we should type the 0.844 in the random.
Yeah, in R&D.
Not in the.
In R&D.
What is the formula of Q3? Q3, yeah,
So Q3, GoalSeek will provide you.
So
Okay.
you have 94.
But for now-
95, right?
If I type on 844,
95,
you got 95?
Yeah.
Yeah, you have 95 too.
So it found then another solution, okay. So let's do this.
Is 8355.
Just a second. Yes,
Did you use goal seek or you just showed?
yeah, I showed how to use GoalSeek, but then I typed the number so that you get my results.
Could you please show one more time?
The GoalSeek,
Yeah, yeah.
yeah, so the GoalSeek, for example,
Percent so.
if you go, yeah, so if you go to what if,
Mhm.
GoalSeek. Now, what is our objective? We want to have only 100 securities here, right?
Mhm.
So choose this cell here. And only 100 securities. And we want to change this number. And push OK. And push OK. So your number may be different.
mine doesn't find anything.
Okay, I'll come to you, just 1 second. So let me first try to fix why 0.844 doesn't give us exactly 100.
One of your summits, 399.
So can you show me this Q6 formula?
I just typed it next to it.
Okay, but did you use the same cells in
Yeah,
GoalSeek? Okay.
Yeah. This one is 0. 281.
Just a second, can you scroll up? Let's see.
No, now it's 400.
Yeah.
Okay.
Just 1 second. What if GoalSeek set cell this one, can you type 100? Changing this one.
I think it's gonna work more.
What?
I think so. No,
Oh, so something is wrong. Let me see. Let's try. Maybe. Sometimes it happens. You choose R2, R3, okay, and then you choose C6 and P6. Okay. is this one. Q6 to Q4 and 4, okay. On 4. So, yeah, so because it is an optimization, sometimes you have to show solver the right path. It
So
doesn't.
what did you change?
I didn't change anything, or I had to initialize with some values.
Okay,
So yeah, let me explain this to everyone. So it is an optimization tool, right? There is no finite math that determines there are possible there may be multiple solutions, right? Our objective can be met multiple ways. That's why you see 100 securities with different numbers, with different values for R&D, right? So sometimes what we have to do, show solver the right path, follow this path. And how do you do this? We want to initialize some values. You'll see more of this in later when you use solver. So goal seg is kind of a solver, but a smaller one, we cannot add any constraints there. So let's try one more this. Let's try this one. First type 0 here. And then what if goal seg Q4 needs to be 100? And by changing cell, R&D, push OK. How much do you get?
0.830, 0.8320.
Okay,
I didn't get it. Kind of,
how much do you get?
I didn't get it.
Okay, so. Mm-hmm. 100. No, choose Q3. Okay. Very good.
I have the same number as yours.
Very good. So we have to initialize with 0. So did you get 0.832?
Yeah.
Okay, very good. Did you get 0.832?
No.
So let's try. No, before you do that, cancel. Enter 0 in R&D. So we remember I mentioned we have to bring solver the right path. So we told solver start with 0. Now 100. Not this one, the next one. Yeah, push OK. You have 0.72. So because usually 0.004. Now try again. You don't have to select a row. Yeah.
No.
Okay, very good. So sometimes we have to tell solver start with 0. Then it is more likely to give us same results. So it is an optimization. It just tries with different possibilities. Okay. But I want to see 0.8. Still 95. Let me check one more thing. You don't have to do this, what I'm doing now. I want to see if I can identify the reason for differences. I see. So. Okay, so we are good. It is just a matter of different solution, okay? So let us try goal seek again. This needs to be 100. Oh, before I do that, I want to initialize with 0. And then want to initialize with 4. Bear with me 1 second. Yes, initialize 0 and then try goal seek. Everyone has 0.832? Okay. So we are good. Now what we are going to do is we will say this is our group 1. This is our group 2. This is our group 3. This is our group 4. So the first 100 is group 1. And you can track first 100 in this column. So go up to 100. So 100, 100. Just pull down to 100.
Stop. We stop at so WPG.
So this 100, there should be TER. So match with column H. So your 1 should end at this 100. Column H. Your 1 should end this 100 and row number 105. And then 2, the next 100 is 2. We'll go up to next 100. So this will be up to NBR. And then 3 will be the third 100. Java, you're good?
Mhm.
And then just 4. Okay. Another thing we are going to do is we are going to copy from here. So I6 to M 405, Control C. Yeah, copy this part. I'll help you try to catch up from here, and I'll help you. Highlight this. So from I6 to M 405. And copy.
I6.
Yeah, to 405. Right. Copy and then paste here, T. Right click, values. So this is our index weight sorted and PV weighted, right? And we are going to copy this column. This indicator, Control C. And paste as value here, right click.
The first 100, or all of it.
And the entire column indicator. And then paste as value to the saved indicator. Now remember, whenever there is one, that means this stock is selected in the sample, right? So what we are going to do for ease of our copying, we are going to highlight from R to X to the end, and then sort. So again, this part,
Where do you put, what's the one from the same indicator?
so this one is copy from this, but
Oh,
a
okay.
copy as values,
Oh, okay.
So
copy as values.
So we're taking from indicator or saved indicator?
So we copied indicator into the saved indicator.
No, when we're taking, you were taking the whole table,
The sort to sort,
yeah,
you take from saved indicator Yeah.
to which one?
to the last and to the end.
To grow sector, okay.
And then sort by, make sure this is unmarked. First, we are going to sort by saved indicator, which is R,
So
largest to smallest. We want to show the selected securities at the top so that we can copy right away.
it's Largest to smallest.
From largest to smallest, yes. And then we are going to sort by index weight, which is U at level. So this at level does sequential sorting, not independent sorting. So sorting within sorting. So it will be U, largest to smallest
When we add the level.
at level. And then,
U, at level U.
yeah, U, yeah, index weight.
Largest to smallest.
And then your PV. Just 1 second, do I need PV? Yeah, PV, so. Let me check, just 1 second. Do I need PV? I don't close this yet. I just want to check one thing. No, we don't need actually PV. So you did sort R largest at level U largest and push OK. And you have this, right?
So there's just two, column R and column U.
Yes, R and U. Yeah, so this is how I sorted. And largest to smallest in both cases. Now we can verify another way that we have the same result. So you see this subsample exposure. We want to find out from which group how many stocks were selected. From which group, meaning those 1, 2, 3, 4. So what we are going to do, sum product of the safety indicator column log, comma, int group log equal to
Safety indicator.
this, close. And close.
Product. Safety indicator. Log RNT. Group. The iron.
So we have 52, right? Okay.
71.
And then pull down. Fourteen, 19, 15.
Can I say format?
Yeah.
The first one.
You guys have the exact same numbers?
Equals. So the A6, you type it manually?
You can select this cell. So that is the A6.
You pull down.
Can I move on?
Yeah.
Yeah, okay. So the first 100 stocks, that is our sample. And that sample was created with 52 securities from group 1, 14 from 2, 19 from 3, 15.4. Okay. Now, so we completed sample selection. Now optimal index portfolio. What we have to do, we have to construct a portfolio that minimizes the sum of squared differences in weights computed in basis points between the portfolio and the index and meet the following constraints. Okay. What we are going to do, we are going to copy from here the first 100. Control C. And then paste as values. So copy these columns, the first 100, and paste as values here. Okay, now first what we are going to do, solver needs to find out the optimal weights here, right? We are going to initialize, we have 100 securities with equal weight. We are going to initialize with equal weights. Because there are 100 securities, it will be 1% each. If there are 50 securities, it will be 2% each. Just to bring solver on a particular path of iteration.
1% for all of.
Yeah. Yeah. And then we are going to calculate active weight, right? What is active weight?
See, without formatting?
Without formatting, yeah. What is active weight? So difference in weights between the index and our security. Okay, and that will drive the differences in return also, right? That is why we want to minimize this difference. First of all, we are going to find out the difference, which is our weight. Again, this is our numbers. Solver will eventually find out, minus our index weight for the security. Close, it is saying in terms of basis points, we have to multiply by 10,000. Okay,
Minus. Why do we multiply by 10,000?
we are converting into a basis point. And then raise it to the power 2. Squared differences. So that one positive difference doesn't cancel out another negative difference. And our differences are understated. So that doesn't happen. That's why we square them. Okay, and then pull down without formatting. Now our objective is, remember, we are still working on index portfolio, but with a smaller sample. And why we are doing a smaller sample, it is costly to full replicate, right? If we want to buy all the 500, 400 or 1000 securities that are in the index, it is a lot of transaction. So we want to create a sample that is a very representative of our index, right? So we created the sample, but then how much to weight to each security? We want to find out optimally. And that optimal weight depends on the differences in weights and also some constraints. So we have to minimize the difference in weights, so which will be sum of all these squared differences divided by 10,000. Did you follow so far? We want to minimize the difference in square differences. Sum of square differences, right? Because if we can keep similar weight, our portfolio will also be similar. Okay, and then what is our target? Our target is to match with the index. So what we are going to do, enter equal, find out these values from our index statistics, which is the data template. And then pull down up to non-cyclical. And then I'm going to change some formatting here.
The data.
Yeah, so what you do, enter equal sign
D3.
and go to data template.
D3.
Yeah. So, and then this one I want to show 2 decimal. These ones percent 2 decimal. So this is our target. We want to match as closely as possible. But we are going to be flexible because it is a sample after all. Let's say our tolerance is 10% plus minus.
Gonna pull it down?
Which one?
Are we gonna pull it down?
Pull down which one?
The 3.5 and
Yeah, pull down, yeah.
it doesn't give me that. It's giving me a different value.
Do you have these same numbers in this template?
Yeah.
Okay. Then pull down. Up to cyclical. Yeah, that's, yeah, you are getting the right answers. It's just a matter of settings. Not this one. Yeah, no problem. So, and then we want to allow 10% plus minus, right? So our minimum range will be,
We type the 10%.
Yeah. you type. And then this target times open parenthesis 1 minus this 10%. Close.
One minus.
Okay. Now max will be target times 1 plus 10%. Then pull this down. Actually, Excel got confused, so pull this separately. And then these two separately. And then what we are going to do, show them in percent. So show them. Show these in percent. Up to 2 decimal. Now we want to calculate what are the characteristics of our sample that we have so far. We did not optimize yet. So some product of our weights, comma, market cap.
Some project.
Yeah, for PV.
We lock the
We lock everything here except for B6. Because we want to pull down. So these satisfy these constraints, right? And we also want a fully invested portfolio. That means the weight, our target weight should be 100%. That should equal to sum of our weight.
So for the 57%, just pull down.
Yeah.
G14.
Okay, now we are ready for solver. Go to data. Solver.
Yes.
Yeah.
For the weight over there, the weight
You type.
type, okay.
You have this one.
Yes, I've got this one.
Okay. Now solver. Our objective is to minimize, right? Okay, and which cell? This cell. Choose minimize. And by changing which cells? Weight, very good. And then our constraints, right? Our constraints. So these values up to this, right? Up to non-cyclical should be less than equal to our maximum range, right?
The max or the mean? The constraint.
So there should be less than the maximum value. Add, and they should be greater than equal to our minimum value. What happened? Yeah, good.
Yeah. The constraint.
So, yeah, choose this one. This one should be less than our max. And this one should be greater than our minimum one.
Greater than or equal to.
Okay, and then our sum of the weights needs to equal to this. Okay. So, and then finally, all the weights needs to be greater than equal to 0. They should be positive.
should be 0.
Okay, we are done, so okay. Unmark this. And then solve. So unmark this and then solve. Is that how much you got?
Yes,
Is it okay? Is it okay when for the weight I entered 100, but I'm seeing 1 there? Is it okay?
Sorry, say again.
The weight I entered 100, but I'm seeing 1.
Yeah, that should be okay. Probably it's a matter of.
That's what I entered 1. Yeah, 100.
Okay, so now you have two, actually. Oh, that shouldn't matter, actually. No, you're right. It's percent. Now solve.
Still 100.
Yeah, that's okay. Yeah, it's a matter of formatting. You can change it. Okay.
So let me solve again. Or is it okay?
You can solve again, but that shouldn't change anything actually. Yeah. So. But let's do this. Let's solve one more time. See if we can improve it further. So solve just again. Okay. So it was not able to, right? Does everyone have the same number?
5, 6, 3, 2, 9, 2.
3292. Okay. So there is a more optimal result, but for now we'll be happy with that. Okay. So this is our optimal index portfolio. We created a sample first of 100 securities that match, I shouldn't say match, that reflect the major characteristics of the index, right? The market size, market cap, right? And also value growth in this fold, because our sample includes companies or stocks from each group, right? Of course, we can improve it further, but we were happy with that. And then we just matched the characteristics. Now we want to find out, wait, that is what we did in this optimal index template, right? So that is our passive portfolio. Now we want to create an optimal active portfolio.
I'll just give a minute.
Yeah. So optimal active portfolio. Why don't you guys take a break for 5 minutes? Okay.
The homework gonna be like this too?
All right, welcome back. So we'll try to finish the last step.
Okay, so we'll go and fix it. You already sort, but before we sort. Securities up to. T or group number 1. And then from 1 to the 101 to NBR will be group number 2.
Is it 2 or 3?
You already sorted, so all the numbers already mixed up. So if you have to do it, you have to do it from the beginning. Yeah. But before you sort it, that's how you do 1, 2, 3, 4. But you might be value might be wrong from everything else. Did you already fix something?
So Edward, we are going to start.
Yes.
So what we are going to do. Often is. Control C. Paste as values. Actually, no, just paste, not values, just paste. So we need the formulas.
You copy from where?
And paste here. And then what we are going to do, we are also going to copy Control C.
Just paste or paste as values.
Paste. Okay. Now this one is based on this condition. So first of all, we have the same constraints.
We're gonna copy the constraints also.
Yeah, we copied everything. Copy paste,
Just paste or paste as value.
just paste. So now we have the same constraints, but now we want to maximize the investor's utility given his or her level of risk aversion. And you probably remember this formula, right? Okay, so what we are going to do, and also we are going to use alpha. Alpha is a measure of abnormal return. Meaning, let's say CAPM is a model, predicts that the return, expected return is 10%, but portfolio manager has a better model. He predicts it will be 12%. This 2% is your alpha. It's a measure of abnormal return. Okay. So we want to maximize alpha. But because we are talking about utility, we need to account for risk aversion coefficient. So to keep things simple, we just made up some alpha based on random numbers. In practice, these alphas will be generated from an effective fundamental or quantitative process. Okay. So what we are going to do here, sum product of our weight and our alphas multiply by 100.
So this is not related to any of this, but basically all the 100 stock that we just picked is having a large growth potential, pretty much. Based on the,
One was large growth, yeah.
yeah, so all those 100, okay.
52% is from there.
Yeah, just want to make sure.
Yeah. So I expected a better solution so that the representation is much more proportionate. Instead of 50% from group 1, 30%, something like that. So if we so the solution that solver gave us is not the perfect solution, but to save time, I did not keep solving. Okay, so there are possible better solutions. Okay, in that case, our sample will be much more well distributed in different groups. But very good question. So now we are trying to manage this portfolio actively, and we want to maximize our utility. One part of the utility is our alpha, but we need to subtract now lambda, which will be our This lambda value we will type here. We did not type yet. And then times our measure of risk. In this case, our measure of risk is, we already calculated here, right? So sum of these squared differences. But then we have to divide by 1,000,000. Why 1,000,000? So when we calculated this active weight, we multiplied by 10,000, right? And then when we squared it, 10,000 became 10,000 times 10,000. Isn't that right? So 100,000,000. You guys follow me so far? So this you multiplied here 10,000, right? And then when you square, it became another multiplied by another 10,000. So it became 10,000,000, right? So sorry, 100,000,000. It became 100,000,000, right? 10,000 times 10,000. Squared. So 100,000,000, right?
Yeah.
But look at the alpha. These are in percent, right?
Oh, okay,
So what do?
divide by 2.
We divide by 1,000,000.
Mm.
So now they're in the same unit. That's the reason. Okay. I will enter. What is the risk aversion coefficient level? 1. Now, what I'm going to do, one more thing. Number of holdings,
Number is 1.
lambda is 1. Count if the weight is greater than 0. I want to find out which securities are selected from here. How many? So I will use a number format here. And what I'm going to do, start with equal value as before. Just 1 second. Okay. Now,
That's 100.
Hmm?
It was 98, right?
yeah, I changed the weight to 1 to everyone.
1, the 1.04.
1% here, yeah, and then pull down. And then you go to data, solver, reset everything. we want to maximize.
Reset all, right?
That's true. And then these. And then add our constraint. So these are the constraints. You can go ahead and solve. It may take a little bit of time.
Let's,
Yeah, just 1 second. Let me see how much I get. How much did you guys get?
68.
68?
9.
I have 4.02.
Should be in that scale.
Oh, 3.9. Same.
You got 3.9? Okay, very good. Then we'll stop here. Yes, Edward, you had a question?
I just wanted to see, okay,
You mean the constraints?
yeah, the constraint here.
Yeah, so this is what I did. Let me clear out here. So. For your constraint, this. That should be less than equal to the maximum value.
What's the number you got again? 3.93?
Yeah.
Okay.
You got this one, Edward?
F8. Yeah.
And then this. Greater than equal to your mean. Yes, and then you highlight, sorry, not highlight, let's do this one first. This one equal to this.
G9 equal to. Add.
And yes, and then all these greater than equal to 0.
Okay.
Push OK. Make sure this is unmarked and solve. It gave you an error. Let's see. Yeah, I'll check just 1 second. So let me do. So for your homework, you also need to calculate active share. So let's do this. So active share is equal to sum of absolute value of these weights divided by 2. Close the entire thing. And then divide the entire thing by 10,000. So active share, just find out differences in weights. It's much simpler. Let me see.
It should be active way. You choose a small one, it should be H for the active way, not way.
Okay, that's true.
You try to enter yours, let's see.
Oh, yeah, I didn't do that yet.
No, not yet. Oh. That's
36.
46, but is that how much you got?
6.
It's not working.
So you did not solve yet, so your number will be different. Yeah. Java, you're good?
It's not working. It shows value.
I see. Okay, so, okay, I'll look at yours just a second. Let's complete this one, sum product. Alpha. Please. 5.5. Go to decimal and you should be.
Yeah.
Yeah. So yeah, I don't want to hold you too long. So if you are done, you can go. You have to do a part of it for your homework, and I'll give you more information about the project on D12 and also talk about it next week. Okay. So let me look at yours.